Welcome back, ladies and gentlemen. So far, we've talked about general ledger account. Rather, we've talked about assets. We've also talked about liabilities, and now I want us to talk about revenue stroke income. Then from there, we'll proceed to expenses, and then we'll move to equity. So when I talk about revenue, what do I mean? When I talk about income, what do we mean? So when we talk about revenue, we are saying that revenue is the value of all sales of goods and services recognized by a company a period. So the period can be in terms of years, the period can be in terms of months, the period can be weeks or days. So the sale of such kind of goods that we need to recognize in terms of days or years or months is what we are calling revenue. So again, we are saving revenue forms the beginning of a company's income statement and is often considered the top line of a business. So when you want to come up with an income statement, when you want to come up with a statement of financial performance, or rather when you want to come up with profit and loss statement, revenue or income will always be on the top. So we'll start with the revenue. Then now you'll come and deduct your expenses or net of your expenses. Then after that, you'll be coming up with your net income or net profit. So that's why we are saying that revenue, also referred to as income or sales, forms the beginning of a company's income statement and is often considered to be the top line of a business. Expenses are deducted from a company's revenue to arrive at profit or net income. Okay, is self-explanatory. And then we are saying here that we are talking about the revenue recognition principle. There's a principle that we need to apply when we are recognizing. Sorry. There is a principle that we need to recognize when we are talking about revenue. We are saying, according to the revenue recognition principle in accounting, revenue is recorded when the benefits or risk of ownership have been transferred from the seller to the buyer, or when the delivery of services have been completed. So when we transfer the risk of ownership from the seller to the buyer, we need to recognize revenue. For example, now we need to sell some goods, and then the customer has accepted ownership of those goods, even though the goods we are still holding in our office, but the customer has accepted our invoice. Yeah, he has accepted the delivery terms of these goods. We need to recognize that we've earned revenue. So we have goods here. We are selling to the customers. The customers has received the invoice. He has acknowledged the payment terms of these goods, even though we are still having these goods. So we need to recognize that we've sold goods worth this particular amount to so and so customer. So that's why we are talking about the revenue recognition principle. In short, by the customers accepting the terms of payment, they are accepting the invoice, and they are accepting the amount they are supposed to pay, even though we are still having the goods with us. We need to recognize that we've sold the goods to the customer. So because we've transferred the risk of ownership from our business premises to the customer, meaning by then when we are doing the invoice, it means that from our stock, these goods have been removed from our stock. Now they're supposed to go to the customer. So we need to recognize that as revenue. And then we are being told that or we are saying that the transfer from the seller to the buyer, or when the delivery of services has been completed. Maybe we are doing the servicing of cars, so we've serviced the car to the customer, even though the car is still in our premises, but we've serviced the car. So the delivery of servicing the car has been done, so we need to recognize that revenue. So that's what we mean by revenue recognition principle. So let's move on. So let's go back to the categories of revenue. So the categories of revenue, we have goods, we have services. So goods, will buy goods from suppliers, add value, then sell. Or services, doing a service. We'll be doing a service to maybe a different client. Maybe we are repairing a vehicle, or maybe we're just doing different services. Maybe we are offering transport services. We are offering clinic services. So we need to recognize such kind of services as revenue. So here we have goods, also we have services. And then we are saying now that we have, we also have expenses. So expenses here, what do we mean by expense? So we've talked about revenue. Also revenues are it's quite direct. We have revenue in terms of goods. We also have revenue in terms of services, and we also know how to recognize revenue. So what do we mean by expenses? So when we talk about expenses, we are talking about that money that is outflowing from the business and to aid the normal operations of the business. It's the money that will aid us to get revenue from our customers, but it's going out. Like now we can pay rent, we can pay salaries, we can pay goods that we've stocked. We call those expenses. So what is our explanation for expenses? So when we talk about expenses, we are saying that expenses, or rather an expense, is a type of expenditure that flows through the income statement and is deducted from revenue derived at a net income. So those kind of expenditure that deduct from your revenue come to your net income. We call them expenses. So we have two categories of expenditure. We have capital expenditure. We also have revenue expenditure. So here, revenue expenditure is what we are calling the expenses, because they pass through revenue, or they pass through, or rather, we need to deduct them from our revenue to arrive at net income. So we call them revenue expenditure or expenses. So again, we are saying due to the accrual principle in accounting, we've seen various principles of accounting. Accrual was one of them, and the matching principle was also one of them. But here we are saying that due to the accrual principle in accounting, expenses are recognized when they are incurred, not necessarily when they are paid for. Okay, what do we mean? We recognize expense when we incur them and not when we pay for them. For example, now you're an employee, or rather you're a business, you have employees. So your employees must be paid after on a monthly basis. After delivering their services, you must pay them. So after every month, you need to pay your employees. So let's say we are in February. So the employees, or rather we are in the end, towards the end of February. When February is ending, employees will have provided their services in the period of February. When the February ends, they need to be paid. When February ends, so let's say February is ending on the 8th. So at the end of the February, on the 28th date, you need to recognize that you incurred an expense salary. You need to recognize that expense of salary in your books that you need to pay your employees. So when you recognize that expense that you've incurred, we are saying the accrual principle says that you need to accrue that expense because you've incurred it but you've not paid. We are saying accrual principle says that expenses are recognized when they are incurred and not when payment is made. So you cannot wait to record the expense of salary maybe after February, maybe you pay them 4th of March. So you cannot wait until March to recognize that expense of salary that you want to book now, the expense of salary in 4th of March. No, after incurring that expense in February, come 20th of February, you need to put into your books that you've incurred the expense of salary. So accruals principle says that expenses are recognized when incurred and not when cash is paid. So you will incur in the expense, you will recognize the expense, but payment will come after. So accrual, yes, we are talking about the current level accrued expense of salaries. So let's proceed. So that one is explained. So we have two different types of expenditure. So we are calling expenses as revenue expenditure and capital expenditure as also another expenditure. So capital expenditure is when now you buy assets. You are buying capital assets, you are buying vehicles, you are buying furniture, you are buying some equipment. So we call those capital expenditure. They will appear in your balance sheet and not in your profit and loss. When you buy an asset, those will come under financial position of a business. So the records of your capital expenditure will always appear in your balance sheet, will never appear in your profit and loss statement. So what do we have as revenue expenditure or other expenses? So we have two types. We have operating expense and we also have non-operating expense. And we also have variable expense, rather fixed, and we also have variable expense. So here we are not saying that non-operating expenses are variable. Yeah, they are variable, yes, but even the operating expense, some are fixed. So when you talk about operating expense, what do we mean? Well, let's see what operating expense means. So here we are saying that operating expenses are expenditures or OPEX refers to those costs incurred by a business for operational activities. When you are operating, those expenses, those expenditures you are incurring as a result of your operations, we are calling them expenses. In other words, operating expenses are costs that a company must make to perform its operational activities. So those costs that you must incur to make operational activities, we are calling them operating expenses. So the common operating expenses for a company include rent, include payroll, utilities, of insurance. When you talk about utilities, we mean water bill, we mean electricity, we mean telephones. Those are what we are calling utilities. And we have insurance, we have maintenance. So maintenance, you must maintain your car, you must service your car. Maybe the repairs of your building, not the major repairs. We have the small repairs of the building. When you talk about partition will come under fixed asset, because it could be a big partition to the building. So that one will be capitalized as an asset. So when there's small repairs like painting, doing these small maintenances, those one we are calling expenses. Then you also have property and taxes. We have office supplies. We have depreciation. We are talked about. We also have advertising. So these are the common operating expenses. So when we talk about non-operating expense, we are saying that expenses, rather, a non-operating expense is a business expense that is not related to a company's core business operations. So they are not related to the company's core business operations. The most common items that fall under category include interest expense, okay, and the loss on sale of asset. So when you have an asset, you've been using asset, so you are in a business, but you are not. You are in a business, and you are making goods, and then you are selling. But when you sell a good, it's always a profit. When you are selling goods, it's always a profit. Because when you go to a business, you are going to a business to stay, but you stay in a business when you are making a profit. When you are making sales, you always make a profit. But comes at times when that you are making sales to some particular goods, and then you make a loss. So when you make a loss on those goods, we call them non-operating expenses, because they are not usual routine of what happens in the business operation. In your business operation, what happens as a routine is to make a profit, not to make losses. Okay. So when making losses is a business routine, and is something that is common in a business operation, that we can call that one operating expense. But when making a loss is a non-routine business operations, it is a non-operating expense. Then we are also saying that other types of non-operating expenses include assets write-downs, and one-time restructuring or legal expenses that do not regularly occur in the normal course of business. They do not regularly occur in the normal course of business. So these are what we call non-operating expenses. So let's go back again and see what we mean by fixed and variable expenses. So here we have fixed and we have also variable expense. So let's see what we mean by fixed expense. So when we talk about fixed expense, we are saying fixed expense are costs, or rather fixed expense costs are a type of expense or cost that remains unchanged with an increase or decrease of the volume of goods or services sold. A typical example is the salary to an employee. When we employ somebody, you'll be telling them on a monthly basis, you'll be paying them $30, or rather maybe $1,500 on a monthly basis. So the $1,500 that you are paying on a monthly basis, it does not depend whether the sale of goods increase or the sale of goods decrease. So when you sell 30,000 units or when you sell 20,000 units, or when you sell 100,000 units, you'll still be paying the $1,500 as salary to that employee. So that one we are calling a fixed expense. And then we are also saying that they are often time related, such as they're often time related, such as interest or rent paid per month. Okay, that is self-explanatory, and are often referred to as overhead costs. We also refer to fixed costs as overhead costs. They are fixed costs, they will never change. They are being paid on a monthly basis, maybe weekly, um, um, or maybe half yearly. They are time based, so they are fixed costs. We also call them overheads. They are important to attaining more profit per unit as a business produces more units. So here it means that when you produce less units, you will not get more profit because the fixed cost will not change. But when you produce more units, it means you will sell more units and you will get more revenue. When you get more revenue and then you subtract the expenses, whether variable or not variable, it means you'll get more profit because the fixed cost or so there are some expenses that will be fixed. They will never change whether you sell more units or less units. So the more you sell the units, the more you get the profit because some expenses are fixed. So we also call them overheads. So what do we mean by variable expense? So when we talk about variable expense, we are saying variable expense are expenses that vary in proportion to the volume of goods or services that the business produces. So let me give you an example where you have rather you are doing manufacturing. So when you are doing manufacturing, you'll do manufacture to the final product, but now you are getting your raw materials from outside. You get raw materials from the suppliers. So when you get the quantity of your raw materials will depend with the number of units you want to produce. When you want to produce 1,000 units, it means that you need to get more raw materials. When you want to produce 500 units, it means that you will get raw materials that is equivalent to producing 500 units. We are saying variable costs are expenses that vary in proportion to the volume of goods or services that a business produces. In other words, they are costs that vary depending on the volume of activity. The cost increase as the volume of activities increases or decrease as the volume of activities decreases. When you produce more units, you increase more expenses, but when you reduce the volume, or rather when you produce less units, it means even the cost of the raw materials must also reduce. So the common variable costs are direct materials, direct labor, commissions, transaction fees, and utility costs. So I think these are straightforward. So we don't need to talk much more about the variable and fixed expense. So as we move on, now we've covered income, we've covered expenses, and now let's talk about equity. Let's talk about equity. And equity, we said equity. Sorry. Said equity represent the value that will be returned to a company's shareholders if all of the assets were liquidated and all the company's debts were paid. So in short, we are saying that equity is equal to assets liabilities. So in case you were to liquidate, you were to wind up your company, you were to wind up your business, it means that you will sell all your assets and then you'll also pay off all your liabilities. So after selling all your assets and then money you get from your asset, you pay all your liabilities. What remains is what we are calling equity. We are saying equity represents the shareholder's stake in the company. What is the stake of the shareholder? Identified on a company's balance sheet. Okay. Equity is the shareholder's stake. What is the shareholders representing in the business? What do they have in the business? So that's what we are calling equity. So we are saying that equity is equal to share capital plus retained earnings. Remember, the share capital is what we inject into the business. The share capital is the amount that we put in the business so that the business can operate. And then the retained earnings is that amount that is coming from the operations. When you get revenue from your customers and then you net the expenses for the operations. So what remains here is the retained earnings. And then you are saying that equity is share capital plus retained earnings. And then equity is equal to assets minus liabilities. And then from the accounting equation, assets is equal to liabilities plus equity. So that is all about equity. So ladies and gentlemen, let us stop from there. When we come back, we'll talk about something else. But so far so good, and I hope at least you've understood something. So we'll stop at there, and when we come back, we'll talk about the uses of a ledger, or rather the uses of a general ledger. So let's stop at that, and let's meet again on the next video.